everyone. We received a letter from LHDN regarding our intercompany transaction.
Yes, ma'am. LHDN is reviewing our related party transactions, specifically the price we charge to our subsidiary in Singapore for management service and product transfer.
Why is pricing an issue? We are in the same company, right?
But this is related to transfer pricing, ma'am.
Is transfer pricing is allowed in Malaysia?
Yes, but it must follow the arm's length principle according to the Income Tax Act 1967.
What does that mean?
It means the price between related companies, which is our subsidiary company in Singapore, must be the same price that we offer to the independent parties.
To put it simplified, ma'am, if we sell the same product to external customer at 100 Malaysian ringgit, we generally should not sell it to our subsidiary at 60 Malaysian ringgit without strong commercial reason. Non-compliance can result in tax adjustment and penalty.
We notice that company sold goods to a related company at below market price.
But here we have prepared a transfer pricing documentation to justify our pricing method.
However, the pricing does not fully comply with arm's length principle.
Does this mean additional tax?
Yes, there may be additional tax and penalties.
Start this presentation with a concept that may sound technical, yet it happens every day in multinational companies, and that concept is transfer pricing. Imagine a big company with many branches around the world. One company in Malaysia, another in Singapore, maybe another in Japan. But even though they are in the same group, they still buy, sell food, provide services, give loan, and even share technology with each other. The price that they charge each other for this thing is what we call transfer pricing. However, this creates a challenge because these companies are related. They have the ability to decide any price they want. They may set a very low price in one country and higher price in another, sometimes to reduce their tax burden. This is what concerns tax authority. To address the issue, we use something called the arm's length principle. This principle is straightforward. Even though the companies are related, they must behave as if they are independent when setting price. In other words, the price should be similar to what two unrelated companies would charge to each other in the open market, without special treatment just because they belong to the same group. From a tax perspective, this principle is important because it prevents companies from manipulating price to move profit from high tax country and low tax country. By using arm's length pricing, profits are reported more accurately in each country, allowing tax authorities to collect the correct amount of tax based on real business activities. When these related companies conduct business with each other, their dealings are known as controlled transactions. Control simply means the companies are under common control, which means price can potentially be influenced. Therefore, all controlled transactions must follow the arm's length principle to ensure fairness, transparency, and the correct amount of tax is paid. From a tax perspective, this principle is important because it prevents companies from manipulating price to move profit from high tax country and low tax country. By using arm's length pricing, profits are reported more accurately in each country, allowing tax authorities to collect the correct amount of tax based on real business activities.
Next, I'm going to explain about transfer pricing documentation. This is prepared to show that transactions between related companies are conducted at arm's length, and tax authorities require this documentation to prevent companies from shifting their profits to a low tax country. Next, I'm going to explain about transfer pricing documentation. This is prepared to show that transactions between related companies are conducted at arm's length, and tax authorities require this documentation to prevent companies from shifting their profits to a low tax country. In transfer pricing documentation, it follows a three-tiered approach. First is the master file. It provides a high-level overview of the entire multinational group. It includes information such as the group structure, the business activities, intangible, and overall transfer pricing policies. This document helps tax authorities to understand how the group operates globally. Second is the local file. It focuses on transactions in one specific country. It contains detailed information such as related party, transaction, functional analysis, transfer pricing methods, and benchmarking studies. Most companies with related party transaction are required to prepare a local file. The last one is Country by Country Report or CBCR. It presents numerical data for each country where the group operates. It includes revenue, profit, taxes paid, number of employees, and assets. And only large multinational group is required to prepare CBCR. And in conclusion, transfer pricing documentation is an important tax compliance requirement. In this part, I will explain about transfer pricing method which are used to determine whether related party transactions are conducted at arm's length. A transfer pricing method is used to test whether the price charged between related parties is comparable to the price charged between independent parties. There are 5 main transfer pricing method commonly used. First of all, the comparable uncontrolled price method. It compares the price charged in a related party transaction with the price charged in a similar transaction between independent parties. This is the most direct method, but it requires very similar products and conditions. Second is the resale price method. It is commonly used for distributors. It starts with the price at which a product is resold to an independent customer and deducts an appropriate gross margin to determine the arm's length price. The third one is the cost plus method. It starts with the cost incurred by the supplier and adds an appropriate markup. This method is commonly used for manufacturers or service providers within a group. Next is the profit split method. It identifies the combined profit from related party transaction and split it based on each party's contribution. This method is usually applied in complex cases involving intangible or unique contribution. And the last method is the transactional net margin method. It compares the net profit margin of a related party transaction with that independent companies. This method is the most commonly used method because it is easier to find comparable data. And in summary, different transfer pricing methods are applied depending on the type of transaction.
Next, I will explain about transfer pricing adjustment and penalties. Transfer pricing adjustment arise when a company does not follow the arm's length principle in its related party transactions. Under the Income Tax Act 1967 and Malaysia Transfer Pricing Guideline, transactions between related companies must be priced as if they were conducted between independent parties under similar circumstances. This adjustment revises the company's income or expense to reflect fair market value. As a result, the company's taxable income may increase or previously claimed deduction may reduce. Additionally, LHDN may impose a surcharge of up to 5% on the adjustment amount. This surcharge is intended to discourage non-compliance and ensure that profits are appropriately taxed in Malaysia. In addition to this adjustment, non-compliance may also result in penalties under Malaysian transfer pricing regulations. Now, I will explain the penalties involved. Under Malaysian transfer pricing regulations, companies are required to prepare contemporaneous transfer pricing documentation. This documentation must be submitted within 14 days upon request by the Inland Revenue Board of Malaysia (IRBM). Failure to comply with this mandatory requirement, including failure to submit the documentation within the stipulated time, constitutes an offence. Upon conviction, the company may be subject to severe penalties, including a fine ranged from 20,000 Malaysian ringgit to 100 Malaysian ringgit, or imprisonment for a term of up to 6 months, or both. These penalties highlight the importance of timely documentation and strict compliance with transfer pricing rules to avoid significant financial and legal consequences.
Good morning. Good morning. Have a seat. Thank you. Thank you for coming today. I need your advice for the tax matter.
So I have reviewed the document you sent me last night, and honestly, this kind of issue is quite common now.
We want to avoid this issue in the future. What can we do?
So one option your company may consider is by applying an advanced pricing arrangement, or we call it APA.
What exactly is APA?
So an APA is agreement between the taxpayer and LHDN to determine the transfer pricing method in advance.
Ah, I see.
So if you agree, we can explore this option further.
Yes, I would like to proceed the APA application.
So what is an APA? APA is an advanced pricing arrangement, represent an arrangement between a taxpayer and the Director General of Inland Revenue, or between the competent authorities that establish the transfer pricing methodology to determine the prospective arm's length transfer price or specific related party transaction between the taxpayer and its foreign affiliates over a defined period that's subject to specified term and condition. An APA determines the appropriate CPM to ensure that the price of specific cross-border transactions are at arm's length in future income apportionment and allocation. Why APA is important for tax? So, APA is important because it gives the company tax certainty. If the company follows the APA, LHDN will accept the transfer price, and this can reduce the risk of audit, tax adjustment, and penalties. So APA is directly linked to the transfer pricing. So transfer pricing is about the setting the price for transaction between the related companies as if they were independent companies. APA ensures that this price follows the arm's length principle, which is required by Malaysian tax law. Next, let's look at who is eligible to apply for an APA. An APA will only be considered if it meets certain criteria. First, the applicant must be a company or a permanent establishment that is chargeable to tax under the Acts. So second, the business should have a turnover exceeding 100 million ringgit. Third, the application must involve a significant covered transaction like sale exceeding 50% of turnover, purchase exceeding 50% of total purchase, or other transaction exceeding 25 million ringgit. Finally, the transaction must relate to income that is chargeable to tax and not exempted. So basically, APA are mainly for a large-scale, high-value transaction that affect the taxable income significantly. Alright, let's talk about the three types of APAs. First, we have a unilateral APA or UAPA. This is a binding agreement between the taxpayer and the Director General of Inland Revenue. It is basically a one-on-one deal, so only the taxpayer and DGI are involved. Next, we have a bilateral APA, or we call it BAPA. This involves two countries' competent authorities, like Malaysia and other countries. It is more of a coordinate agreement between government rather than just the taxpayer and DGIR. So finally, there's a multilateral APA or MAPA. This is similar to BAPA, but it's involved Malaysia and multiple other countries at the same time. So in a short, all these APAs are binding on everyone involved, but of course they are subject to the terms and conditions that state in the agreement. So let's move on to the APA process. When a taxpayer wants to enter into an APA, there are a few key stages they need to go through. First is the pre-filing meeting, where the taxpayer and DGIR discuss the plan and get aligned. Next is the submission of the formal application, followed by reviewing and negotiating the detail of the application with DGIR. So once everything is agreed upon, the APA is implemented, and finally there is ongoing monitoring and compliance review to make sure everything is followed properly. It is important to note that during this process, the DGIR has the right to suggest alternative method, adjust the scope of the APA, or even decline the application if needed. Also, at any point during the process, the taxpayer must inform the DGIR of any significant events like voluntary disclosures, audit, investigations, incentive approval, or any other facts that could affect the application outcomes.
In APA, the company and LHDN agree on the transfer pricing method to be used for related party transaction. They also agree on a reasonable profit range, the type of transaction covered, and the assumption used in setting the price. This agreement gives clear guidance on how price should be determined for tax purpose. Next, the APA period. APA normally covers future transactions for a period of 3 to 5 years. During this period, as long as the company follows the agreed terms, LHDN will accept the pricing result as fair and acceptable for tax purpose. After an APA is agreed, the company must submit an annual compliance report every year together with the income tax return. This report must be submitted within 7 months after the end of accounting period. The purpose of this report is to show that the company has followed all the terms and conditions stated in the APA. If the company failed to submit the annual compliance report, the APA may be cancelled and the company may be exposed to a transfer pricing audit. An APA gives certainty to the company about the transfer pricing method that should be used. This makes the tax treatment of related party taxation more predictable. APA also help to avoid double taxation, especially for companies dealing with overseas related parties. In addition, it reduces the risk of transfer pricing audit and tax dispute with the tax authority. With APA, companies can plan their tax costs better and reduce the burden of preparing too much transfer pricing documentation.
Approve a unilateral APA for your company.
Thank you. This helps us comply with Malaysian tax law.
With APA, our transfer pricing will be accepted as arm's length. Thank you, officer.
Welcome. To conclude, transfer pricing ensures that transactions between related companies are taxed fairly. However, transfer pricing can also lead to dispute if the pricing is questioned by LHDN. That is why adverse pricing arrangement is important, as it provides certainty and reduces tax risk. Overall, both play an important role in Malaysian taxation.